Hello everyone, my name is Toby, and today we're learning the ropes and giving an introduction to forecasting tools that would help your trading. Why time is the foundation of all forecasting? The markets move based on timing, not just direction. Okay, good trades need to be placed at the right moment. What this means is if you focus on the ups and downs more than the when and when not, then you have difficulties in making good projections in price action. Timing is everything. Even the best analysis will fail if you're too early or too late. That's just what it means. And this timing is highly influenced by news reports and natural repeating cycles. What this means is when there's high volatility in the market, behind the scenes, there's usually some news event or economic data that's been released that's triggering market behavior, market sentiment. Or it could just be natural repeating cycles like yearly cycles or 4 year cycles where we have elections and things are generally uncertain as to where, you know, the country will go if they're a democratic country, of course. And these are the things that we always have to consider in making accurate forecasts. And those forecast ideas or trade ideas are built upon with two aspects, two major aspects. One is fundamental analysis. This is where we're trying to find out what drives the market, you know, in terms of raw data. And these are real world events and data that cause price to expand or consolidate. Understand what kind of news affects markets and how often they come. So basically, over the course of your study, you find that there's certain times in the year or in the month where things just don't move. Okay, like things are stagnant, and then after that moment of waiting and lethargic movement, we have expansion, and then all of a sudden everybody knows what to do. So there's a there's an underlying factor behind that. Okay, so there are different time frames, and I have some examples of key reports that align with those time frames. For instance, the yearly time frame has news data like final GDP, that's the gross domestic product for the year, government budgets, and so on. This data or this class of data is released on a yearly basis. This means that you tend to have an overview of what the next year might look like in terms of price action, considering the currency, of course. And then it breaks down like that, lower and also higher than the yearly cycle. So we have the quarterly cycle as well, also the gross domestic product, both for each quarter. So what this means is January, February, March, that's known as the first quarter of the year. Whatever figures or numbers that the administration can collate about what has happened economically speaking in that first quarter will be released at the first month of the next quarter, meaning that the real moves have already been made before your headlines show it. All right, things are already moving, the pieces are already moving way before it's announced to you. Inflation rates, federal funds rates, all of this news data usually comes out quarterly, quarter on quarter basis, but then how it gets to the public is usually late, right? And by that time, you're either too late for the price move, or you're probably buying at a premium, or selling at a discount. So it's always good that you know what this data looks like on a higher time frame, and then you can use that for analysis and forecasting. The monthly data as well, we have NFP, that's non-farm payroll, CPI, retail sales, and all that. That's released every month. There are weekly news releases as well. When we have FOMC speeches, the chairman of the Federal Reserve, uh, you know, those data actually dictate. They come in, week out, not every week, but any week you see FOMC on the economic calendar, just know that that week is going to be highly volatile. That alone gives you a backstory as to whether you want to be interested in trading that week or not. And we also have daily news data, like bond auctions, political statements, like Trump giving a speech about something urgent, or global conflict like we hear in the news. And those ones also have their effect, but they are secondary to the higher time frame news data. An example of this fundamentals playing out in price is the US dollar during CPI week. I have a screenshot of a website, forexfactory.com. You can use that website to check, to keep current with news releases on a day to day basis, economic news. Let's say CPI is scheduled for Wednesday, as it is here. Some days, some weeks is Tuesday, some weeks is Friday, is Thursday. So it changes, but it's usually around this time on the second full week of each month. Okay. Monday to Tuesday, we expect markets to be often uncertain or choppy, lackluster price action. And that's just because something is about to be announced, and the fact that no one knows which way the number is going to be positive or negative, they can't really make a financial decision. So it shows itself in the charts, right? And then Wednesday, obviously high volatility as traders react, and then Thursday, Friday, price begins to realign based on the outcome. On Thursday and Friday, we also have news releases, but they are not as um, would I say high in volatility as the CPI on Wednesday. And we'll go into the charts to see what that looks like. So I have here my gold USD chart from a week ago. That's the week that has this news release. And we can see I have delineated the each day of the week from the midnight open, Monday, Tuesday, Wednesday, Thursday, Friday, and then Monday again. So this Monday and Tuesday price action, like we anticipate, is not really straightforward in the sense that it is making higher highs here and a higher low here, but then on Tuesday we have a lower low and then makes a higher high again and then back into the range. All of this is just the market stalling, okay, and not giving any definitive direction as to where it wants to go. Why? Because there is an important news event on Wednesday. And as soon as that news data was released, we can see this long wick here, this candle with this long wick. That is the time, the particular time as when that news data came out, and it caused this spike. Okay. And after that, we can see that price starts to expand, meaning that everyone knows what's happening now at this point. Okay. Everyone has a bias automatically at this point. And you can see that Thursday the market corrects, filling up some of these gaps here, and then continues to expand. And then Friday, obviously, more expansion. So we can see from just this last week's example alone that the market usually waits for the right time. And that's what you should do as well as a trader. You don't want to just trade based off of a hunch somewhere. You need time. You need time to show you what price is going to do. Okay, as they are correlated. And for tracking this market data, I have three websites that I like to use. The first one is forexfactory.com, which is what we saw in the screenshot earlier. It's great for economic calendar and impact news. We also have tradingeconomics.com. There are a lot of articles that you can read there about finance, about trading, historical charts and data and all that. And investing.com as well also helps you keep up with most of these market movements. So the other aspect that makes up the other half of fundamental analysis is technical analysis. Okay, this is the actual reading of price movements, and this is the study of time price charts to understand market behavior. After we finished reading up all the articles and then trying to get a feel of what exactly is going on and where a certain currency or commodity is heading towards, we need to get technical. We need to actually check the prices and see what is possible. Where are we now? You always have to ask that question, where are we now in price? You know, we look at price structure, highs and lows, and liquidity levels. Okay, are we making higher highs or lower lows? Are highs being respected or are lows being swept? And where are the liquidity levels? Where are the most stops, the most stop losses? Where are they resting currently? Any point in time that you want to make a forecast about any trade idea, these three things have to be at your fingertips before you even do anything. Okay, you need to know what is the overall structure and price. Okay, are we making higher highs or higher lows? And then where are the liquidity levels? No price indicators. Okay, we focus on pure price action. The reason is because price indicators have a disadvantage, which is that they usually show you what has already happened. And that is useless for us as traders. We want to see things before they happen, not after they've already happened. And that's why price indicators don't really do the job. There is a high amount of strategies that work with price indicators. If you're still willing to research them, that's fine. But personally, and for the purpose of this series, we won't be making so much use of price indicators to make our forecast. We want to focus on pure price action, and technicals show where price is likely to move next. Okay, you need to use chart data. Combine this with fundamentals for the full picture. Okay, after you've done all your homework with reading the news, and then you've read price movements on the charts, then you can go on to the next stage of determining where you are in the market. Okay, premium and discount. Know where you are. It's very essential that you know in every price range there are two key zones. You're either in a premium price level or you're in a discount price level. And what this means is that you're either at a point in price where things are too expensive, the price is too expensive, and you should be looking to be a short seller, or things are very cheap, meaning prices are really low, lower than they have been in a long time, and you should be looking for buying setups. You should be a long buyer. And then in the midpoint of these two zones is equilibrium, where price is neither cheap nor expensive. It just happens to range and waste time and waste time. So because of this, because we know these three key would I say key aspects of price movement, we don't chase price. Okay. You let price come to your zone of interest. Okay. You wait, you buy low, you sell high. You buy low, you sell high. You buy low, you sell high. I can't stress that enough. That's the basics. You don't buy at an expensive price and you don't sell when it's cheap. And this is usually the consequence of making decisions that are not informed. You end up selling when everything has gone down and buying when it has already gone up. So you don't chase price. Charting platforms where you read the markets, these are tools that let you watch and study charts in real time. Okay, this is the work that you have to do. You have to open up your charts, pick a commodity, currency pair, whichever, and you study. Basically, you look at it, you repeatedly look at what is happening, and you gradually build your analysis skills. It doesn't just happen overnight where you just now know what you're doing. Okay, you will need these three softwares or at least two of them. I use TradingView for my analysis because it has clean charts, it's easy to learn, perfect for strategy development. And then I use MetaTrader 4 and 5. Either one is okay, but I use both of them for execution, for putting on trades, and CTrader as well, because it's also very nice. I like the interface. It's very nice for putting on trades. So we'll be making use of TradingView for future training on this series. So I advise that you install TradingView and MetaTrader 5 or 4 and CTrader. Your trade journal. Your trade journal is the best trading book written by you. This quote is from Inner Circle Trader, and it goes without saying. Okay, most educators don't talk about the importance of a trade journal, and in my experience, I've seen how crucial it is to keep track of your progress right from the beginning. If I had put in more focus in journaling from the beginning, there are many mistakes that I wouldn't have had to repeat to call myself in order. Okay. So with your trade journal, what you want to be tracking is the date and time of your analysis whenever you decide to make one, your bias, if you're bullish or bearish, and why. You know, why are you buying or why are you selling? If you cannot answer that question within your own consciousness, you're not ready to trade. Okay, you are not ready to trade. Don't bother. You need to have a bias. Even though you could be wrong, your mind needs to be tilted to one side at least until you're proven wrong. That's just how bias works. It doesn't mean that you're 100% correct. It just means that more than half of your what now analysis leans towards one side. Okay, that's what bias means. It means that you are more on either the bullish side than the bearish side, meaning that you see more buying opportunities than selling opportunities because you need to be open to both of them upon your analysis and then arrive at either side and stick there until you're proven wrong. That's how bias works. Okay. What you expect and what happens, these things need to be put in your journal. Okay. Before you make the trade or as you're making the analysis, you ask yourself, what are you expecting? What are you expecting to see in price action? And then after it plays out, you also go back in there and say, okay, so I expected this, but what happened? What really happened? And you also need to take note of your emotions prior to your execution. Okay. It might not sound important right now, but trust me, you need to know. Were you hesitant? Were you feeling confident? Were you feeling greedy? All of those things play their roles and are signals for you as a trader, as an individual, in making these financial decisions. And then you also need to write down what you learned overall. You know, each day you learn something about yourself and the markets. Okay. You either win in trading or you learn. You don't lose. Okay. You either win or you learn. What gets measured gets improved. Okay. Keep track. So we're going to be using demo trading for practice ground. Brokers let you access the real markets on the demo account. So you're going to be trading with fake money, but with real market prices, real market price action. So you can understand the gravity of what you're getting into, the highs and lows. Even though it won't cost you any money and you wouldn't make any money, you're getting used to the environment. And bit by bit, you understand more and more. Okay. The brokers I recommend, Exness, you can open up a demo account with any of these brokers and complete your KYC, select the demo account, and then use TradingView for your analysis and journal as you practice. So when you open up the demo account, you want to sign in with the details on MetaTrader. Okay, that's how it works. You take the information that your broker gives you for your demo account, and then on the MetaTrader app on your computer or your mobile phone, you sign into your demo account on any of these brokers or whichever broker you choose, and you start trading. Basically, you do your analysis on TradingView and you trade with your demo account, and on your journal you track your progress, you track your practice, and make sure that you're keeping up with what you're doing. You have to be conscious about every move just so that you're not repeating mistakes. Okay. A mistake is not the bad thing in trading. Repeating the mistake is what is scary for anyone that wants to get into this profession, because now it's no longer a mistake if you know about it. Awareness is what clarifies that this is not a mistake anymore. This is just maybe a lack of preparation. That can also play a part in your trading. Are you prepared? Are you fully informed about what this week has to offer, what this month has to offer, what this quarter has to offer? When you can determine that before you even get into the charts, then you're halfway there. So it now takes you to practice and practice and practice. So, like I've been trying to point out, everything works together full circle. Okay, you use news data and time cycles to choose which markets to trade. Use price structure to choose where to enter, where to exit. Use a trade journal to track and learn. You use your demo to build experience. Okay, you build experience with your demo accounts, trading, trade whatever. Okay, no mistake is wrong at this stage. If you're just starting, if you're new, if you're brand new, make all the mistakes that you want to make. Blow all the demo accounts you want to blow. It does not matter right now. All you need to do is make sure that you are tracking all of this. Okay, keep in mind that your emotions and then your bias needs to be clear cut before you execute the trade. And then after, find out if you're right or wrong and also record it. Okay. Forecasting is the intersection of time and skill and awareness of global events and trends. Okay. It takes a lot of work. But as soon as you get it going, it's like a snowball effect. You tend to understand more and more as you do it, as you practice. You don't do it today and then come back next month and think that you have a month's worth of progress. You stick with the tempo, you stick with the times, you stick with the trends and understand what's happening. What's next in your learning journey? Well, how to break down yearly, monthly, weekly, daily cycles and all of that. How to know what kind of trader you are. How to prepare for each trading week like a pro. Understanding market makers and why they trap retail traders. These things will be discussed in our next episode as to how you can find your footing, okay, as it pertains to you, the trader. Now you're a trader already, okay? How it pertains to you, the trader, what kind of trader you are, and how you can quickly navigate your moods and your own personality in the markets. Okay. From person to person, it ranges. Okay. We are not all operating on the same frequency in this life. And so therefore, even with something like trading, what works for me might need to be slightly adjusted for you. It doesn't mean that it won't work. It just means that because it's a different person, different things need to be considered. And if I tell you that all size fits all, that is not 100% correct. That is not true. But again, there are rudiments, there are foundational pieces that will make up your entire strategy as a trader. And you need to find out what works for you consciously. You need to be as aware about what really works for you. Okay. Stay curious, study your notes, and your accuracy improves with time as you continue. Thank you. I hope to see you in the next episode. Like, share, and subscribe.